Hello everyone, welcome to the KLI Market Commentary for the month of June 2023. I am Manoj Bharadwaj and I focus on managing fixed income investments at Kotak Life. Today, I'd like to share our assessment of the recent global as well as domestic developments and our rates outlook for the month of June. The global economy so far has shown sustained resilience, employment gains remain strong and unemployment rates have fallen below pre-pandemic lows. At the same time, global core inflation remains elevated and has stayed above 5% over the first few months of the year. Despite growth and inflation surprising to the upside, central bank commentary suggests that they are at or near terminal rates. Multiple considerations are pushing central bankers to go slow on tightening. There is increasing consensus that policy stance is now sufficiently restrictive to bring inflation back to acceptable levels. Monetary transmission works with a lag, and central banks are therefore turning cautious in light of the recent banking stress and tightening in lending standards after the fastest pace of interest rate tightening in decades. On the domestic front, India's growth prospects remain strong, with RBI projecting FY24 GDP growth at 6.5%. Manufacturing and services sector activity remains buoyant. Corporate earnings are beating consensus expectations, with banking and financial sector posting strong performance aided by robust credit growth. On the fiscal front, tax collections remain strong, with GST collections posting a record high in April. Higher than budgeted RBI dividend for the year is expected to offset any increase in expenditure during the year. The external sector metrics have also improved meaningfully, with the recent trade deficit coming in at a 22-month low of about $15 billion, aided by lower commodity prices. Additionally, healthy trends in services exports bodes well for current account deficit, which is expected to narrow to under 1.5% of GDP as against our estimate of 1.9% of GDP for the previous year. On the domestic inflation front, headline inflation eased below 5% in April 2023, the first time since November 2021. Recent price trends suggest that Q1 inflation may average comfortably below the RBI's projection of 5.1%. While the current inflation prints are supported by a favorable base effect, risks to inflation remain skewed to the upside in the event of adverse weather conditions. A potential poor monsoon remains a risk to inflation, but we think that rates are sufficiently high to anchor inflationary expectations. On the liquidity front, system liquidity conditions have started to ease in light of higher than budgeted RBI dividend and RBI's variable rate repo operations. In addition, RBI's recent announcement to withdraw 2000 rupee currency notes can reduce the drain on liquidity at least in the near term. Deposit rates may therefore ease, but the resultant G-Sec demand from banks may be limited amidst excess SLR holdings. Bond markets have had a strong start to the year given the pent-up demand from insurance companies and mutual funds and the repricing of rate hike expectations. For the medium term, we remain constructive on rates, even as we witness increased volatility in the near term given the uncertainty around the global growth, inflation, and fiscal dynamics. The MPC meeting is slated to take place between 6th and 8th June. With the repo rate at 6.5% and CPI below 5%, we see the MPC holding rates steady in the upcoming meeting and continuing to assure markets of adequate liquidity to finance the productive sectors of the economy.